It is almost 1 p.m. in Sydney, 11 a.m. in Hong Kong. Welcome to Bloomberg Markets Asia. I'm Haidi Stroud-Watts. Here are your top stories. Asian equities slip following a sluggish day on Wall Street as investors prepare for a rush of earnings headlined by Nvidia that will set the tone for risk assets. 7&I shares fall as Bloomberg reveals the 7-Eleven operator is seeking Japanese government protection as Canada's Couche-Tard circles. Plus, HSBC's incoming CEO said to be considering a plan to cut layers of middle management when he takes charge next month. Let's get you straight to the markets and see how they're faring as we await for the big one. Avril Hong is in Singapore. Avril.
The big one, indeed. There is one event we're watching in the market. So no prizes for guessing what that is. It's really that Nvidia earnings report. We get some consolation prizes in the lead up to that in terms of data out of Australia as well as some earnings. But let's take a look at how markets are faring. It's pretty tight ranges. These Asia stocks trading volumes lower than usual this time in the session. And we're seeing the dollar catching a bit of a bid, interestingly enough, and gaining ground against all its G10 peers except for the Australian dollar. And this is after the Aussie inflation print came in slightly hotter than expected, although it is lower than the prior month. Now, flip the board because as you see there, Hang Seng Tech is down today. Yesterday, we saw that sell-off on the Chinese e-commerce names sparked by concerns related to Pinduoduo and what it told us about the Chinese economic woes and intensifying competition. It's a bit mixed on Alibaba and JD today, though they both fell about 4% just a day ago. Keeping an eye on Meituan as well. It's likely to show slowing sales growth, but as I say, it's really all about Nvidia. Heidi.
And as everyone and I have just been talking about, the big countdown continues to those numbers out of Nvidia. Let's get more in terms of a preview from our tech reporter, Annabelle Jewellers. So are these expectations every time just keep them building, and it's just such an influential stock, perhaps the most that we've seen.
Well, it is the most influential stock. I mean, you think about the weighting that it has in the S&P 500, it's at 6% now. And it's the first time ever we've seen a company reaching such a heavy weighting on the index in record. And so that really makes it not only something that can contribute to the swings, it also means a lot more volatility perhaps because of the Nvidia numbers. And we can get to it in just a moment, but we could see a swing as much as 10% either side today. But the expectations, well, the revenue side, we actually could see some very solid figures being reported. So a 70% revenue growth for the current period. Some on Wall Street are saying we could see even better numbers than that. And we have seen that price action over the course of this month, about a 10% run up in the stock again, telling us that some, again, are tipping that we're going to see a blockbuster report. But certainly, whatever we get out of those second quarter numbers, the forecast as well, that sets the tone for AI spending for the rest of the industry.
So much scrutiny. What else will investors be looking at?
Well, investors also want to get a bit more of an understanding around the lineup because earlier this month we had reporting about the Blackwell chip, and that series is expected to be sort of the next generation of AI chips. The concern perhaps is that we see a delay in that because there are concerns about production halts coming through. We just don't know the timing of it. It's just, is it something that's a couple of days, couple of weeks? Maybe not such a big deal for the bottom line. If it's a couple of months, then perhaps it becomes a problem. But Blackwell chip production is expected to ramp up in the second half of this year, start to feed into the bottom line rather into 2025. Need some level of reassurance around that.
Belle, how exactly are markets bracing for these numbers from Nvidia? I mean, you alluded to some of this based on what we're seeing in the options market.
Yeah, options are saying we're going to get about a 10% swing either side here today. So clearly, as I say, markets are bracing for quite a large impact from this. Again, it comes down to that weighting it has on the S&P 500 index as well. In terms of what else we're tracking for the numbers today, it has been that sort of question mark around volatility because we've been watching the volatility not only on Wall Street overnight, where we saw it very, very subdued. I think the thinnest trading volumes we've seen, or the second thinnest trading volumes we've seen for 2024. That's also playing out in the Asian session so far today as well because we've got trading volumes well off their 20-day moving average, and you can see that using the AVAT function here, which shows us again about a 40% drop on where we would typically be. So it's again that amount of trepidation, that amount of nervousness. What are we going to see reported today? But certainly, as we can see from investors, analysts, many say there's further upside from here. Morgan Stanley, for instance, is one with a note out. Their price target is $144 $34 on the stock, and they're saying even with concerns around the Blackwell chip, even with concerns around headwinds, for instance, China export controls, still there is room to run.
Annabelle Jewellers there with a preview. And a reminder, of course, the Nvidia CEO himself, Jensen Huang, will be speaking exclusively to Bloomberg Television after the second quarter results drop. Bloomberg Technology's special coverage begins at 6:30 a.m. Thursday in Hong Kong. That's 6:30 Wednesday evening if you're watching in New York, Avril.
Yeah, we will be watching with bated breath. Arguably, in this week, he's the world's most influential man. But as we watch out for those Nvidia earnings, we are also watching out for potentially, is this going to trigger a bit of risk on, risk off, given its market cap? What is this going to mean cross assets? Is there going to be an impact? Let's bring in our next guest. Wayne Gordon is MD of Commodities and FX at UBS Global Wealth Management. So, hey, Wayne, great to have you in the studio with us.
Yeah, nice to be here. It feels a bit like Melbourne Cup Day in Australia, actually. That's what I was thinking as Heidi was talking.
Yeah, I mean, there is so much anticipation, right, ahead of what we're going to get from Nvidia. But what is your sense of, God forbid we get a miss on Nvidia earnings? Is there going to be a bid up in treasuries and the dollar? Yeah, look,
I guess the first point I'd make is that when I think about these sort of big announcements from companies like Nvidia, clearly we're going into this as well with a pretty positive outlook. For us, it's though more about guidance. So traditionally they have tended to just guide about a quarter ahead, 2 quarters ahead. They haven't really gone really long term in their guidance and expectations. And so they're the things that we're really looking for is the CapEx spend and how that then translates through to maybe companies are just not spending enough in that context, right? So from our perspective, yep, the quarter results are interesting, but it's actually that guidance, et cetera, that comes through. Now, obviously, data in the US has been pretty mixed of late. We've had some, more subdued data, but then we've had some more optimistic data, such as durable goods and so forth, right? And of course, we had very dovish comments from the Fed at Jackson Hole. However, as we look forward, payrolls and CPI are going to be the key drivers here, and in particular, the focus is now on the labour market for the US, particularly given Jay Powell's comments at Jackson Hole. He is, obviously not willing to withstand too much more weakness in the labour market. Consequently, if those non-farm payrolls numbers are a bit on the weaker side, we have seen some revisions going back of late, but if those numbers are a bit on the weaker side, clearly the Fed is probably going to move a bit more quickly, and that's what we're thinking right now with around that sort of 100 basis points cut before the end of the year. So we think the macro is going to be the principal driver of the dollar here, as well as yields, etc. But of course, US stocks have done extremely well. We've seen a lot of investment going into the US on the back of that, and that has been part of that stronger dollar story that we saw in the first part of this year.
So structurally, longer term negative for
on the dollar in particular, yeah.
But how much further do you see it falling? I mean, given how much has already come down.
Indeed. So in the short term, there's probably a lot more volatility. We have a similar view for the tech sector where we think there's a lot of big events, such as the Apple iPhone release, for example. More of these sort of tensions between the US and China around trade and so on, right? These things are going to deliver volatility, not just to the tech sector, but also things like the US dollar. So in the short term, there's definitely, the dollar has run a long way, technicals are pretty stretched, and yes, in the short term, there can be a bit more volatility here, up and down. But longer term, we think the structural drivers of the dollar, such as the Fed continuing to revise down rates, as well as the fiscal deficit influence on the dollar, we think begins to pay through. Not only that, but as the dollar begins to come off, some regions actually would do a little bit better out of a weaker dollar relative to a stronger dollar, right? Emerging markets in particular, where we expect that growth will start to bottom and we'll start to see some pickup. So there, in that context, we think that a weaker dollar is definitely positive for things like emerging markets, and you might start to see a little bit more of a rotation out of the US into EM.
And when impactful when it comes to the commodities outlook as well, right? I just want us really to take a listen to what we heard from the Fortescue CEO a little bit earlier.
The plateauing of steel in some senses would spook the market, but for us, that plateau is at a much, much higher level than it's ever had been before. And again, that bodes well for an organization like Fortescue. We are very confident in those long-standing relationships we're having with China, getting us through this next period.
So, Dino Otranto, they're kind of striking the same tone as Mike Henry when we spoke to him yesterday following BHP's numbers, that sense of resilience, at least for higher grade Australian iron ore. Do you see that playing through even if we haven't seen the bottoming out of China's steel issues yet? And does that sort of structural slowdown that Abel referred to just before have a meaningful impact going forward for commodities like iron ore?
Look, I think there's a real divergence in commodities, and we've seen that through much of the second quarter, and particularly in the rebound, where we've seen copper rebounding pretty strongly. Part of that, of course, is on the supply side, and some of those issues around mine production out of Chile, for example, which is causing some of these constraints. But iron ore, from a longer-term perspective, simply the supply growth that I've seen out of many of the forecasters simply indicates that you're going to see supply greater than demand, and you're going to see a small surplus building in the iron ore market over the next couple of years. In the short term, we still have a relatively balanced market, and in the short term, high-grade iron ore can do better as margins on steel production in China in particular remain very, very difficult indeed. And in fact, we've seen some companies in China suggesting that it's the worst it's been in almost 2 decades. When we saw BHP yesterday, they talked a lot about pivoting to copper, and they gave very little commentary around iron ore. And we think that that pivot to copper is something that's going to also be seen across other mining stocks such as Rio Tinto and so forth. So copper is definitely expected to be the driver of growth over the next few years. And of course, that makes sense when you look at the number of projects in the pipeline relative to demand pickup, as we expect that despite some of the short-term volatility around renewables, we think that this push to electrification and renewables will continue. And so consequently, iron ore will take a backseat, and I think in this context, copper will be the commodity to watch.
That plays into the outlook for Australia more broadly and the Aussie dollar, right? We did see the inflation numbers cooling on a core basis for a second consecutive month, but certainly not enough to dissuade the hawks at the RBA, you think?
Look, inflation was expected to come down, and in part it was because of the material subsidies we saw in energy as well as rents and so forth from the budget a little bit earlier in the year. So I would actually argue that inflation didn't cool, and that's clear by consensus, that inflation didn't cool as much as expected. And so consequently, we have the RBA not moving until the start of next year, i.e. cutting rates by 25 basis points then. And then we'll think it'll be a pretty moderate cutting cycle relative to some other central banks, such as New Zealand, where we think that they're going to have to dig a lot deeper where the data is materially worsening. So overall, when we look at momentum in the Australian economy, it is not strong, but it is also not deteriorating markedly here. And so consequently, with it, the RBA will be one of the last central banks to cut. Consequently, the Aussie dollar can perform very nicely against the New Zealand dollar, as well as against some of the other currencies, which are still low yielding, will be low yielding relative to the Aussie dollar over the next 6 to 12 months.
Wayne, why do you think the RBA is going to be able to defy peer pressure and easing, though? I mean, we're seeing how in the bond space, I know that's not your, wheelhouse per se, but traders don't quite believe that we're going to see that RBA continue to be able to stick to its guns.
I think definitely the reaction we saw in the market today, i.e. the Aussie dollar spiking up when those numbers came out, suggested that the expectations of a full rate cut by the RBA by the end of the year in the pricing of the bonds market is starting to be taken out. And my view is that they'll push that into next year. And not only that also, but the fiscal situation in Australia is quite strong still. Admittedly, it is probably going to weaken somewhat because iron ore prices have come down and so forth, and the government benefits from that. But nonetheless, it is going to be relatively strong, which means that the amount of debt that the Australian government have to issue is also lower. So you've got this sort of interaction between inflation being stickier for longer and also lower issuance, which means and demand for Aussie debt is still pretty strong. So consequently, you have these sort of tug tug of war going on. But nonetheless, I think that inflation, sticky inflation in Australia, is going to persist because the labour market is still very, very tight. And in fact, we saw the Deputy Governor revising up the employment NAIRU, i.e. that point where they think they're around the neutral rate of unemployment. He revised that up by about 25 basis points. And so consequently, as long as the labour market holds up, we think the RBA will be on hold until February.
Fair enough. And go along, Aussie. Wayne, great to have you in the studio. Thank you so much for sharing your insights with us. Wayne Gordon of UBS Global Wealth Management. Heidi?
Yeah, April, still ahead this hour. Bank of America joining us to talk about the latest deal-making trends that we're seeing across the Asia-Pacific, plus the consulting firm BCG will be coming on as well to share their outlook when it comes to India's fintech industry. Before that, though, sources telling us that HSBC's incoming CEO is eyeing a sweeping overhaul that would remove layers of middle management at the bank. We get details of our exclusive next. This is Bloomberg. The incoming HSBC CEO, Georges Elder-Harry, is said to be considering plans to remove layers of middle management at Europe's largest bank. Our China correspondent Min Min Lo joins us now with more. So what do we know about the restructuring moves?
Yeah, so we're hearing that HSBC may be trying to remove some of these middle management roles, so things like your country heads in part of its global network, and the new CEO might be looking to change some of the roles that will be reporting to him as well when he take over the reins officially from Noel Quinn in September. And this is perhaps an early signal of how the new CEO is going to put his stamp on how he will take the company going forward. But in some ways, it is also a continuation of the sort of changes that we have been seeing for a while now under Noel Quinn, with thousands of job cuts and the company really selling off some of its biggest operations in North America and Europe, including its Canadian and French operations. And so far, we know that HSBC has also been kind of pausing or slowing down hiring, choosing not to replace some people who have left, for instance, and calling on its bankers to scale down on some of their spending when it comes to travel and entertainment expenses. And the context of this is that we are going into a global economic slowdown, with central banks around the world going into a rate cutting cycle that is going to cut into profit margins for banks. So this is likely to be an effort to rein in those costs so that the company can really focus its resources on the areas where they see their most competitive advantage in.
Min, what exactly could HSBC look like after the restructuring?
Yeah, well, we are seeing the company perhaps pivoting a little bit more to Asia, back to Greater China, to Hong Kong, where, of course, the company was founded, more than 150 years ago. We are seeing the Chinese economy not really doing very well, quite lackluster activity when it comes to the deal-making space. But we know HSBC has ambitions to really build on its wealth management segment of the business, and they really want to overtake UBS, which is the market leader in this part of the world. And also, we know that HSBC has been going through a revamp, a restructuring, if you will, of its investment banking segment to try to streamline it to mimic the structure that Citigroup has created as well. In fact, we just spoke to the head of investment banking of Citigroup. He was quite optimistic about the space in Greater China, and he talked about how those streamlining has paid off. And what HSBC is doing is in some ways mirroring what some of its rivals are doing as well, what Stan Chart Citigroup has been doing in terms of skinning the fat and really restructuring, reining in costs here as we head into a slowdown of economies around the world.
Our China correspondent Min Min Lo there in Hong Kong. Plenty more ahead. This is Bloomberg.
Welcome back to Bloomberg Markets Asia. We're seeing markets in a wait and watch mode. It is a holding pattern. U.S. stock markets already closed pretty flat overnight, but you see from futures here a bit of a negative picture, maybe a bit of caution ahead of those Nvidia earnings, but really it is the way that investors are sitting on the sidelines in anticipation of the world's most influential stock dropping its earnings report, Heidi.
Yeah, and on the topic of AI, of course, we've been looking at investors eager to see delivery on efficiencies and value. And one place we've already seen certainly the impact of artificial intelligence on jobs is the world's call centre capital, the Philippines. Our Bloomberg Tech reporter Annabelle Jewellers takes us through the industry's rapid transition and what it could mean for white-collar workers worldwide.
It's a vital part of the Philippine economy. Business process outsourcing, or BPO, accounts for 1.7 million jobs and makes up about 8% of GDP. However, that could soon change as major BPO players introduce AI tools.
Some of these processes that are more human-led today will be a mixture of human plus machine-led, in the years to come.
Consulting firm Avascent says up to 300,000 contact centre roles could vanish within 5 years in the Philippines as a result of AI technology. Mylene Caballona is the head of a labour association representing BPO staff and has already seen changes.
Switching to AI has been, displaced workers. There's one company who basically just removed their entire line of business because they switched to AI. And that's like 300 workers affected, and it's going to continue.
It's not all doom and gloom, with the possibility that new jobs will be created instead.
You will need a lot of AI trainers. You will need quality assurance on these AI models. You will need auditing on some of these AI models. You will need fine-tuning on these AI models. And agents that are already in the workforce, they have an opportunity now to upskill themselves and play some of these roles.
Mylene Caballona, though, says many more are set to be displaced, a shift that will continue beyond the nation's borders.
One software can support like 300, then that's 300 workers that's going to be out of job. The risk is not just to the workers in the Philippines, it's workers all over the world.
Annabelle Jewellers, Bloomberg News.
Take a look at what we're watching when it comes to some of the movers in the Aussie session, and of course seeing some reaction across bonds as well as the currency to a slightly less cooling in that monthly inflation figure than expected. Still a second month of declines when it comes to that core number. We are seeing quite a divergence when it comes to trading across the big miners today, of course, in the thick of earnings season. Fortescue now reversing those earlier gains to be down by 1.7%. This, of course, really projecting a view of resilience as we saw in those numbers. The profit missing forecast, higher costs are starting to play out for that impact, but certainly quite a bit of confidence when it comes to the impact of the structural slowdown in China, though, and also some concerns about how its sort of diversification efforts are going with issues with its hydrogen ambitions. Linus, this is the rare earths miner, of course, seeing upside of 3.5%. We're seeing some pretty decent earnings for them as well. Those shares down about 5% year to date, though, and we also are seeing some gains for earnings optimism out of Woolworths and the gold miner Perseus mining there up by 7.3%. Coming up next, Bank of America saying that M&A volumes in Southeast Asia up 30% from a year ago. We'll take a look at the latest trends in deal making next. This is Bloomberg.
Welcome back. Let's take a look at how markets are trading across Asia. We're looking at these Chinese mainland benchmarks heading into the lunch break with declines on the CSI 300 of about 0.6%. Of course, sentiment is very weak, and we've been seeing these reminders about the weakness in the Chinese economy, no less from these big e-commerce names, but also from the likes of Nongfu Spring. It's showing how its profit growth slowed. So among the headwinds, I think, for Chinese equities at a time when investors investment sentiment is already languishing. A bit of a weakness coming through on the Chinese onshore yuan. This is, of course, against the backdrop of the dollar slumping that's been taking a bit of a breather today. Let's flip the board and take a look at how Japanese markets are faring, because, of course, it is that holding pattern ahead of Nvidia earnings. Trading volumes are lower than are typical this time of the session. And as I say, given how the greenback has been faring today, perhaps unsurprising what we're seeing on the yen, keeping an eye as well on 7NI. Heidi.
That's right. Overall shares of the convenience store operator are lower today in Tokyo. So many developments. The latest one emerging in the takeover battle brewing between the 7-Eleven owner, I should say, and Couche-Tard of Canada. Bloomberg has learnt that 7&I is attempting to get Japanese government oversight of Couche-Tard's bid, which could derail plans for what would be the country's biggest foreign takeover. Our China Chief North Asia correspondent Stephen Engel has more on this. And so this idea of a core designation. Steve, I want to know what do nuclear energy, rare earths and aerospace and egg sandwiches have in common here?
Yeah, that's the next question for Who Wants to Be a Millionaire, right? Well, they want to be designated as a core company in a core sector that's basically supplying food and necessities, perhaps during natural disasters, which they have in the past. Look, 7-Elevens, there's 21,500 or thereabouts of them across Japan, 85,000 worldwide. But in Japan, they're part of daily life, the ubiquitous konbini, as they're known, of course, where you can get those egg sandwiches and onigiri and the like. But you can also get municipal services like official documents. You can go to the ATM. There's 7&I Bank. There's all kinds of different services. So the logic here, according to sources, is that perhaps to fend off this quote-unquote friendly and non-binding offer from the Circle K owner Couche-Tard of Canada is to get government backing to designate 7&I as a core business. Rightfully, as you just said, Heidi, in line with other companies and sectors that are considered to be security, national security issues. That's aerospace, rare earths, nuclear energy, and the like. Now you can potentially, that's where we're all watching whether the government backs this, you can add the convenience store to that list of core companies. And if they do, that would mean the Ministry of Finance can and would vet any kind of takeover bid that includes a bid of more than 10% of the company that they're trying to acquire. So that could potentially thwart this big deal that Couche-Tard is hoping to fulfill.
Yeah, Steve, we wonder whether the Japanese government that has taken this protectionist stance in the past is going to do so at a time where it has been really trying to reinvigorate things in Japan, changing corporate guidelines. What extent do you think this is going to be a good litmus test for it?
I think it is a litmus test, and I think people will be watching how what the appetite for that kind of purchase will be in Japan. Whether they, of course, go along what has been, par for the course to sort of protect. There's been a number of cases where certain industries, certain companies that were trying to be acquired by overseas companies have been essentially thwarted for various different reasons. It's an interesting tack that 7&I is taking, but again, there's reasons why the stock is down today, because again, that activist investor, Value Act Capital, they've been trying to sort of force a breakup of 7&I. They say they're not returning shareholder value because the core business, 7-Elevens, are undervalued because of the underperforming department stores like Ito Yokodo. That's the I in 7&I. We're also getting a Nikkei report that came out this morning in the 9 o'clock hour saying 7&I is moving forward with closing about 33 of those underperforming department stores. So that's a step in the right direction to get some of those shareholder demands of restructuring. But again, and it seems like 7&I is trying to make these steps to make it more attractive. But keep in mind, Couche-Tard and Circle K, they have 9 times more enterprise value per store and a bigger market cap than 7&I, and they're much smaller. So again, this might be a move by Seven & i to buy some time, get a little bit of protection, a muscle from the Japanese government to be able to pull off some of these restructuring moves and hold on to these core kombinis.
Yeah, I wonder how much backing they're really going to get. Stephen Engel, our Chief North Asia correspondent, thanks so much. Now, global M&A is heating up. Southeast Asia has turned into a hive of activity for deals, and it's helped by relative economic and political stability. And let's discuss the outlook with Martin Seah, head of Southeast Asia Corporate and Investment Banking at Bank of America. So, Martin, as we've just been hearing there, obviously Japan is where we're seeing things being shaken up, but in the Southeast Asia region as well, in terms of deals, what are you seeing so far this year?
Thank you for having me. I think as a start, Southeast Asia is at the cusp of a super growth cycle with 450 billion of record FDIs in the last 2 years. It's a 3.6 trillion GDP in terms of economic region and home to 600 million population. I mean, with a rising middle class and very favorable consumption and demographic growth profile. So Southeast Asia has been the hotspot for in terms of M&As. Volumes are up more than 30% year to date. So we are very bullish on the M&A outlook for Southeast Asia.
What are you seeing in terms of overseas investor interest into Southeast Asia from the likes of Japan or the Middle East? What is the allure for them?
I think the main sectors of the potential interest are mainly in the healthcare, the digital, both the traditional and also the conventional sectors, renewable energies, and also financial services. So there's plenty of capital, especially from the Japanese and the Middle Eastern companies. I mean, who are looking at Southeast Asia, as they pivot some of their potential investment, from the rest of Asia.
Has that sort of geographic interest come at the expense of weakness elsewhere? Where have you seen markets where there has been more restraint or even outflows of interest and funding?
Yeah, I think the majority of the interest, has been focused on Southeast Asia, and we are seeing a drop in volume in the rest of, especially in the case of Northeast Asia. So Southeast Asia has captured a major share, of the global in terms of FDI, close to 17% of it, and it's becoming I would say the M&A destination of choice for many of the companies that we cover.
What about the role that Singapore is playing? Because obviously it's this gateway for the Southeast Asia region. What are you seeing in terms of why, obviously there are a lot of factors at play here, but why Singapore?
Singapore has the, I would say the largest share of the global FDI, close to 70% last year, and majority driven by, the financial services sector. Singapore is the regional hub and spoke, so many of the companies, would position Singapore as the regional hub for their treasury management and also for their Southeast Asia in terms of operations. We have seen a sudden frenzy in Singapore in terms of M&A activities, and my bankers, on the deal front, have been kept, very busy, year to date.
What about the IPO pipeline? Where do you see sort of most activity? And as we see this recovery across a lot of markets, what's going on in Southeast Asia?
I think for our pipeline, I see a lot of positive contributions, mainly from the healthcare, the digital infrastructure, and the renewable energy sectors. These are mainly in the companies that are both leveraged to the global FDI and also to the strong domestic consumption stories.
Martin, Singapore is also a place where I think authorities are trying to reinvigorate the stock market. We see this task force being established to look into it. Do you have a wish list when it comes to equity capital markets in Singapore?
Well, the IPO and the equity capital markets, in Southeast Asia, as a whole, has been at a, I would say a 12 to 18 months, pause. Year to date, the volumes are down, probably lowest in the last 5 years. I think, from an IPO standpoint, I'm seeing in terms of IPO, green shoots. These are IPO green shoots at work in the pipeline. And as rates and market conditions are, stabilize, I would expect there to be a potential resurgence in terms of IPO activities, heading into next year.
Can you quantify it? What extent?
Yeah, I mean, the Singapore IPO volume, is down, by a lot. But I think in the areas of, digital infrastructure and consumer retails, I think these are potential green shoots for a resurgence in IPO activities. Especially these are the areas that are leveraged to consumption growth and also to the inbound foreign direct investments.
Martin, obviously the big deal story of the day, of the week, the month, and maybe of the year is certainly looking at Japan and what happens with the 7&I situation, right? There are some concerns that we might see that reversion to protectionist measures from the government. I'm keen to get kind of your broad views around that and whether you see sort of the regulatory approach really changing for different markets and how that impacts the willingness of investors to be making that bet.
Yeah, I think the ASEAN governments have fostered very close in terms of economic ties for more than 55 years, and the regulatory environments for capital markets activities, in terms of inbound mergers and acquisitions, I would say lots of the Southeast Asian countries have been pretty constructive. So there has been a lot of, in terms of M&A activities, both in the listed space and also in the private space. And these volumes are testament to the very conducive regulatory environment for more in terms of M&A activities. And not just in terms of inbound M&A, but we're also seeing lots of cross-border regional Southeast Asian in terms of M&A transactions. And going forward, I'm hoping to see more in terms of outbound in ASEAN, in terms of the mergers and acquisition activities, as confidence returns to the boardroom.
Yeah, a lot of Singapore companies looking overseas for acquisition opportunities. But Martin, we've been talking a lot about opportunities and tailwinds. What about risks? I mean, we are in a U.S. election year. What are you seeing in terms of the U.S. FDI into the region?
I would classify the major risks to the stability and the robustness of Southeast Asia as the global FDI hotspot, as the geopolitical risk. I think geopolitical risk is the major risk to the stability of Southeast Asia. But we are at the cusp of a super growth cycle, based on the new capital commitments to Southeast Asia, especially in the AI, the digital sectors. These numbers have already testified to very strong in terms of FDI and potential deal making in terms of market environment heading into next year.
Looks like you have your work cut out for you, Martin. Thank you for coming in and sharing the plans and the outlook for the industry. Martin Seah, Singapore Country Executive and Head of Southeast Asia Corporate and Investment Banking. Haidi.
Yeah, everyone, more conversations coming up with BCG joining us next, discussing their outlook when it comes to India's fintech industry. They'll be talking about how the AI boom could impact the sector next. This is Bloomberg. The calm before the storm, or the calm before the exuberance, right? As we see really Asian stocks so far in this session just falling. We've got disappointment from Chinese earnings, as well as trepidation and anticipation before Nvidia's numbers. Take a look at what we're watching when it comes to the start of the trading day in India. The Sensex coming online just sort of modestly higher there, as we see the Nifty also just trading water at the moment in the early parts of this trade. Banks doing a little bit worse there, about 0.2% lower. The Global Fintech Fest kicks off in Mumbai on Wednesday. Our next guest has authored a report on risks that may affect India's fintech industry and the banking sector. Let's bring in Neetu Shudkara, who's the MD and partner at Boston Consulting Group. Neetu, really great to have you with us. So I guess talk to us thematically about some of the risks, but also the opportunities that have been identified here.
Yeah. I think AI is definitely one of the big opportunities that we see as part of the report. And we see that in three specific areas. We see in terms of driving efficiency, enhancing customer experience, and also improving risk management. As you'll see in the report that we released at GFF today, we find that for banks as well as financial institutions, this combination of predictive AI, which is the algorithms or traditional AI, and then generative AI, can be a very powerful combination. So think of it, let's say the predictive AI is a recommendation engine which based on your data creates recommendations on next best product for you. And then the generative AI adds elements of visualization, text, image, local language, which can then be used to create hyper-personalized offers for each and every customer. Now, this is just one example, but we see applications across the entire banking value chain. So right from sourcing, like I spoke about, but all the way up to collections. Think of even personalized collections, or let's say credit memo assessment, knowledge management. And so we believe that it has a huge impact across the gamut.
Obviously, there's a lot of potential from the technology, but what is your sense of whether the industry value chain is already properly adjusted and prepared for this?
Yeah, so I think value chain, both in terms of technology, but also, the human capital, I think both ends need to adjust. So we do feel that, if it has impact across the value chain, everyone in the sector needs to be prepared for it, or every job would have some impact from the AI. The extent may vary depending upon, different types of roles. Just to give you an example, we implemented a use case on knowledge management for a bank, where you can actually do a natural language querying for any type of circulars or guidelines, which is found in aplenty in the banking sector. And what we find is it saves time for each and every person in the role because they can get all the information very quickly, but it also creates newer roles. For example, who is going to train the AI model? What kind of information needs to go there? What is the governance around it? So AI management, cybersecurity, these are new roles that come up. And therefore, there is a massive reskilling which is required for the entire sector, keeping in mind some of these changes.
There's also a significant cybersecurity risk in India, right? How do you assess that across the sector? Are you seeing financials taking that seriously enough? Because we've seen a number of banks being taken to task for exactly that criticism.
Yes, so RBI has also, increased in their systemic risk survey the threat perception from medium in 2023 to high in 2024. We also see from a bank's perspective, the cybersecurity spends are much lower, about 1/9 of what we see in global banks. So yes, there is room to improve as we think about cybersecurity going forward, and especially with the increase in the attacks, etc.
What, for these banks, are the implications if some of these risks are not, properly looked after, other than regulatory action?
So I would say regulatory action is probably even just the base of it. So, regulatory action of financial losses, that's the very base. But I think as you think about, increasing digitalization, actually having the customer trust is very important. Trust is literally the foundation of the banking sector, right? And if you think about multiple new to banking customers, with these incidents, many of them can lose the trust. And that is, I would say, the biggest implication beyond any financial loss or regulatory action. So reputational impact is very important.
What do you see as some of the other risks that perhaps we haven't been paying enough attention to?
I would say while cybersecurity is more around incidents, we also feel that there is more investments in technology which are required. So on the front end, there has been a lot of digital journeys, etc. but the core still remains a bit fragile. So if you look at, technology spends of Indian banks versus global banks are, let's say, about 7 to 8%. India is about 5%. Even within that, the share of change the bank initiatives is lower. And therefore, we believe, there is a risk in terms of the core, and therefore banks need to invest a lot more in core modernization over the next few years to be able to handle the type of scale and the type of digital initiatives which are coming in. So that, we believe, is a key watch out for the banks to look at.
Neetu, really appreciate your time with us. Neetu Chikara of Boston Consulting Group there. Don't miss our exclusive interview with the Nvidia CEO, Jensen Huang, after those highly anticipated results. It's at 6:30 a.m. in Hong Kong on Thursday. This is Bloomberg. Taking a look at some of the top corporate stories we're following this hour. NFL owners have voted to allow private equity firms to buy as much as 10% stakes in their franchises, loosening some of the tightest ownership rules in professional sport. Deals are expected to happen quickly, with firms including Arctos Partners, Ares Management and others already vetted and approved, and stakes could sell for as much as $1 billion. Goldman Sachs Commodities trading co-head Qin Xiao is leaving the firm just months after taking on the leadership role. According to an internal memo, Xiao plans to leave at the end of this year after 22 years at the company. Xiao was one of the few Goldman partners in that unit who stayed on after the business cratered in 2017 and was rebuilt in the following years. Supermicro shares closed lower in the US session after Hindenburg Research disclosed a short position in the AI server maker. The short seller also accused the firm of accounting red flags and alleged sanctions and export control failures. A spokesperson for Supermicro says the company does not comment on what it calls rumors and speculation. All right, take a look at what we're watching as we see that sort of broad malaise across Asian markets, are waiting, of course, for the big one when it comes to those Nvidia numbers and how that really is spurring a lot of traders at this point to take some protection, right? Watching those chip names, it is sort of quite a divergence. The likes of Taiwan Semiconductor, Advanta seeing some upside, Tokyo Electron, though, and Samsung Electronics trading in Tokyo and Seoul a little bit softer there as we continue to see that super influential role of Nvidia across not just tech but broader risk assets. We're also watching some of those stocks that are reacting to earnings in China as well. The likes of Zhong'an, their online slumping about 19% after disappointment after the first half results. That was the biggest decline on record. Nongfu Spring shares, of course, the mineral water producer, extending that decline to 11%. Slow earnings growth being blamed there. We're also watching Anta Sports as well. A bit of an uncertain outlook despite what was ultimately a profit beat there. 4.4% is what we're seeing trading at higher despite lowering its sales guidance for Fila. Meituan is one to watch as well, off by about 2.2%. The sales growth aspect likely slowed with that broader economic and sort of household slowing that we're seeing in China. That is it for Bloomberg Markets Asia. Horizons, Middle East and Africa is next. This is Bloomberg.